We're live.
Hi everyone, welcome to Tilt Talk, Tuesday Tilt
Talks.
By the end of this, we are going to have that name down. We're here to talk about all things real estate. And we're going to try with me doing more of the talking today because
I lost my voice.
Jared has a bit of a scratchy, froggy voice. I don't think it's going to happen, but I'm going to try.
And I'm going to try to let her talk as much as possible, but I don't know if that'll happen.
It won't, but well, it's a good intention. So today we're going to talk about why might we want to invest in real estate. Last week we talked, and we're going to talk about why we chose to invest in real estate.
Because there's different options. There's stocks, there's real estate, there's coins, cards. There's all kinds of stuff in it. It's just real estate was our vehicle that we chose.
Yeah.
So we're going to share that with you.
Yeah, we'll let you know why we chose it. Then last week we talked a little bit about specifically within a city where we might want to pick some great rental opportunity, real estate investment opportunities.
Well, how to find the property in the city.
Yeah.
Right. So it's one thing to say, I'm going to go buy here, but now where do you start buying in that town? Right. Is what we talked about last week.
So we're going to expand on that today and talk about, okay, so we have the area in the city, but what cities? So
just a recap though, what were some top 3 or top 4? Because you were obviously in on the call last week. So out of last week, what are some top 3 or 4 areas or things to look for a good area to be investing in a city, whether it's Edmonton, Phoenix, Calgary, whatever? What were they?
Well, my big takeaway was Starbucks. I stopped listening once I had a coffee.
You had me at hello. You had me at hello. No, Starbucks. Understanding your tenant profile and what they want. Starbucks versus Tim Hortons. Walmarts, churches. Walmarts versus churches. Yeah. Schools. Middle to middle income or middle class to a little upper end schools versus the schools with the hot lunch programs. Once again, nothing wrong with either program or either school, but it's just understanding your tenant profile. Once you understand your tenant profile, then you go source out the places that they would go, and then you start buying around that area. We also talked about LRT lines.
Right.
And what was the message about LRT lines? Do you remember?
Well, that it's not necessarily.
It's not necessarily a good place to be buying.
Yeah.
Once again, understand your tenant profile, understand who uses the train, and more importantly, how they use the train.
Right.
A lot of people in the city will use a train, but they use it differently than other people due to location. And in Edmonton, what we're seeing is a lot of people driving to the train, hopping on the train, driving to work, versus wanting to walk to the LRT to hop on the train. LRT obviously is light rail transit. So just understand those principles when deciding on what type of area you want to be buying when you're investing in real estate.
Right. Okay. But we're going to start out with talking about why might you want to start investing in real estate. And let's talk about some reasons why we chose real estate.
Because before you get into real estate, you got to understand why real estate. We could have chose stocks. In 2003 when we went to our first real estate event in Edmonton, really we kind of had an idea real estate was our thing, but we didn't really know it was our thing probably until 2005, maybe that year before we bought 64 properties. Up until that point, we didn't really know if that was our thing. So here's what we've come to realize with real estate and why we chose real estate. We wanted a simple return on our money.
Yeah.
Plain and simple. We wanted to put $100,000 or $20,000 or whatever we had at the time for our first house. I think we put maybe $25,000 on for our first house. So we wanted to get a simple return on our investment. So we wanted to get an easy 6 to 10% return on our investment. That's it. So if we put $100,000 into an investment, we wanted to make sure we got 6 to 10% return. Really, that was the bulk of it.
Yeah.
And from there, we thought real estate. That's where real estate started getting really exciting to us, because we were getting the rents from the tenant, and there's other aspects that came along with that. And back in the day, do you remember when we started out? So when we started out, we wrote out our vision, and which is what we call our why or purpose. And how many properties did we want on there? Do you remember?
Very initially?
Yeah, do you remember?
Oh, it was 17.
It was 17.
Yeah.
So we wanted 17 properties. We wanted 3, then we wanted 8, then we wanted 17 into our third year.
Yeah.
And in our third year, we ended up buying 64. But along the way, what started happening, which we didn't really understand, to be totally honest with you, because we never saw it, and we never understood how the concept of this worked. Like we can understand visually and conceptually how it worked, but to actually live it was pretty cool. And that was appreciation. So that's the second reason why we build a real estate portfolio is long-term. It's long-term appreciation. It's not short-term. So what we've come to realize is, I know you said you do all the talking, but
I was joking.
I'm kind of taking over, and I apologize for that. But long-term appreciation. So real estate is a long-term play, right? Yeah. Stocks can go up. It's a quick hit. Right now in the stock market, we're on an 8-year bull run. So the market's been increasing for the last 8 years. Donald Trump comes in and it's kind of continued to skyrocket. I've come to understand what goes up comes down. Mm-hmm. And, stocks is something that we just didn't have the education or the system or support system to get into. But what we've come to understand is real estate is a long-term appreciation play. This is a game that you're playing for the next, the way we're playing it.
Well, and it's funny, Jared, because I remember when we first did our numbers, we had no idea things would appreciate like they have.
Oh, we had no clue.
No, we really underestimated, but the numbers still really work just with debt buy down and over time.
Well, that's the next thing. So the next thing is debt buy down. So both of these things happen on a long-term play. Debt buy down happens monthly because every part of your mortgage payment, a portion goes to principal and a portion goes to your debt reduction, which is your mortgage buy down. So, just with these three things alone, those three things alone helped us get into real estate. Yeah. Because we didn't really understand appreciation because we were told that if you buy a house today and 30 years later, it's gone up in value and here's kind of how it works. But we never felt it.
Well, fundamentally for me, I didn't trust this because my only experience had been I had some RSPs and I would just look at my statements.
Which we just got. We just got our RSP statements.
Yeah.
And
we haven't touched them.
They're gross.
But they've not barely changed.
Yeah, they're gross.
Really, that's a really bad move because I should have moved that money somewhere else. But
hang on.
It's small amount of money.
It doesn't matter. Let's quantify that. Let's qualify that statement. For us, we feel that's a bad move.
Well, I didn't manage it. I've not managed it over the years.
I understand that. But you're going to get viewers out there who say, well, Krista Hope said that this is a bullshit play. Who is she to give stock advice? We're not giving stock advice. What we're saying is we chose real estate. And if you look at the play, the trajectory of our real estate portfolio, stocks, our RSPs are not performing like our real estate portfolio. Yeah. So in our situation, it didn't make sense, and it doesn't make sense to have those RSPs. No. It makes sense to get our ESPs for our kids because there's all kinds of tax advantages, governments match it and all that stuff. So we actually do that. But for us, RSPs just didn't make sense.
Right. But it came down to that it was like, here's a tangible asset.
Correct.
That you can go to the front door of. And you know what you own. I don't get a statement and wonder.
It's a physical thing.
Pieces of the pie might stand for.
So when we first started investing in cities that we wanted to be in. So we started like Edmonton, because we can drive by the house. If something happened, we can go fix it. We can do it. We can touch it. We can smell it. We can feel it. We can grab the tenant by the ear, which I've done,
we can
and pull them out.
Paint all the trim.
We can paint all the trim, fix the windows, toilets, whatever we had to do. But it was a fixed term asset. And to us, that had value. Yeah. To others who invest in stocks, they don't necessarily care because they feel that the asset is in the company that they're investing in or that piece of paper that they're buying. Right. We just don't see it that way. The other thing that we wanted was tax. There's tax benefits to investing in real estate. And, let's give an example. So we got to 8 properties in Edmonton before we expanded outside the city. Right. And the main reason for me to buy inside or outside of Edmonton in a city called Prairie was purely for the tax benefits, because your family's from there. And, so it drove me nuts driving back and forth every other weekend and not being able to write off my gas and, or meals or hotels or whatever it was.
We didn't go every other weekend.
We were going lots. At that time we were going, a lot. In my world, and now once again, I'm seeing the in-laws, so that's a lot. LD and Glenn, if you're listening, you guys are fantastic. No, but seriously, we were going a lot, and we weren't able to capitalize on the expenses of write-offs. Right. So we started buying in Prairie, And that year we started investing in Grand Prairie. We bought 64 properties. And then from there, it's just, exploded really from that point on. So there's a lot of tax benefits. Now, I'm not going to go into the tax benefits. I'm not an accountant. I highly recommend scoring a really great accountant. Go find a real accountant who understands this, the benefits that come along with it. And the best way to do that is find one who actually is investing in real estate themselves.
I just want to back up.
Sure.
So we said initially our goal was 17. There was a reason for that. I don't want to scare people off. Sometimes I think when you say how many houses we have, it might be like, oh, well, there's no point because that's crazy.
Yeah,
and it is crazy.
Yeah.
But to do it again, maybe we wouldn't go so big.
Hang on. So, okay, finish your point on that.
Well, my point is, why 17?
Well, so hang on. Before we answer that question, how about this question? If you were to do it all over again, how many would you stop at? And I've asked this question before online. I put posts up, and everyone has a different answer.
Well,
what would you stop at?
I'd have to do the numbers. I
say 10.
Yeah,
to me,
I'm thinking
10.
17 in my head still, but I haven't done the numbers right now.
So back. Okay, here's another question then. What type of properties would you be buying today versus what we were buying yesterday?
Yeah.
Yesterday being years ago.
Right.
Years ago, we were buying houses that were 10 to 15 years old.
Yeah.
And, and the reason why we picked them, they were buying houses, they weren't suited. They were all single family houses, duplexes, townhouses, stuff like that, garages, ideally. Cash flow and those things were anywhere from $150 to $200 a month. That's what we were being taught.
Yeah.
And so if you were to do it over today, and lots,
yeah.
You're not so much in the transactional side of the business anymore, but you still understand the game.
Yeah.
What would you be buying now versus what we bought then?
Well, they'd have to have more than one unit.
Yeah. So Terry Pranich is a friend of Till. Now Terry's been investing in real estate for years. This guy's probably bought 170 some odd properties, maybe more.
Probably more.
And Terry has a concept of 2 for the price of 1. And, so he was always looking for houses that had minimum 2 units and you get it for the price of 1. So a house with a basement suite, a 4-plex, triplex, 6-plex, small apartment building. Now, if you look at Terry's portfolio, it's full of that stuff. And this is a guy that's been playing this game for 20 years and he's just like, he's set with his portfolio.
Yeah, then it's
smart investor.
Yeah.
He wasn't out buying 100 at a time. He was buying, Terry has a saying, just buy 1 a year. Buy 1 a year in a good area and just watch it grow, watch the mortgage buy down and have massive long-term success.
Yeah. And
he actually lives by that every single day. Now, I'm not trying to plug Terry at all. However, his concept and his model is very, very strong.
Yeah.
So 2 for the price of 1, double suite.
Right.
And renovated, non-renovated, what would you be buying?
Definitely renovated.
Absolutely. Why?
Well, initially we didn't because we were doing some of the work ourselves, but really makeup-y stuff.
Mm-hmm. But why would you buy a renovated property? Or a new product. Now, we renovate houses. Hang on, I want to be clear. We renovate houses. We're not trying to pitch our product.
No.
At no time am I going to sit here and say, call this number, 780-443-1161. You can call it if you want. But I'm not doing that. That's not the point of the show. The point of the show is to teach people our mistakes so they don't go make them.
Yeah.
Renovated versus new. I wouldn't buy new. New's too much money. New builds, you're going to get a 1-bedroom unit. 1-bedroom units are very small and hard to rent out. High turnover in a 1-bedroom unit versus a 2-bedroom basement suite, 1,000 square feet, right?
Yeah.
But why would you go with the renovated one versus unrenovated one?
Because it's going to take less cash flow.
Totally. Costs.
Yeah.
And the 5th thing on why we got into real estate, because we wanted something that was easy.
Yeah.
Now, I want to qualify that statement. Real estate is not easy, right? And we were actually talking before we went live, and Krista was asking me a question if we should talk about how hard it is to do property or to manage your properties.
Well, and the perception of people don't get into real estate because of the landlord horror stories they hear.
Right now, those do happen.
Oh yeah.
And maybe we'll do another call about how to manage a property and deal with those expectations or bad things that show up. But we wanted something that was easy. Now, real estate has not been easy. For the first 10 to 12 years, it has been absolutely fucking hard, right?
Oh yeah.
We almost went bankrupt.
Yeah.
We've lost hundreds of thousands of dollars.
Yeah.
We've made many, many, many mistakes.
Yeah.
We've pissed off people. I've had to evict 10. I've grabbed them by the ears. It's been endless. So it has not been easy.
No.
However, we've been investing in real estate for 15 years.
Yeah.
Has the last 3 years been easy?
Oh yeah, a lot easier.
Right. So we've rounded the hump.
Yeah.
Why has everyone got that? So I'm going to erase this. So everyone understands the 5 reasons why we got into real estate. Now, why has it gotten easy?
We have systems, and
for sure.
Yeah, but we've gotten to a place in our portfolio where there's more buy down.
Right. We've never in our portfolio. So we have a partner where we own 30, 40 properties or something like that with. And every 5 years, we've been refinancing these portfolios. What is that doing? Well, it's just putting stress back on the portfolio. So we're not actually capturing that debt.
Right.
We take the money. Sorry, my voice is starting to get choppy. We've taken the money and done what with it?
We reinvested.
Reinvested it. We bought more properties. We bought down debt. We got into renovations, all that stuff. Mm-hmm. Our partners, what have they done with it? Don't know. So, they've bought cars, they've gone on trips, they've paid for school for their kids, whatever it is that they've done is served them for sure. And I'm not downplaying it at all. What I'm saying is there's 2 different approaches. And what we've done is we've just been buying down our debt, which has made at the 12-year mark, we've rounded the hill.
Yeah.
So now real estate is now relatively easy.
Yeah.
Rents are the lowest rents we've seen in the last 7 years. Mm-hmm. And we're still cash flowing well, not great, but we're still cash flowing in our main portfolio.
Yeah.
In our joint venture portfolios where we've refinanced, we're not doing well. And we're actually feeding those properties.
Really, really hear that, guys. There's a great opportunity to do real estate investment right, in our opinion.
Totally.
Because hindsight's 20/20, and it sure could be a lot different now had we done things differently.
Oh, it would be different. Like looking back now, if we brought properties that instead of that were 10 to 15 years old, 10 years later having to spend money on roofs and windows and kitchens and flooring and all this other stuff, if we're buying houses that were brand new that were cash flowing $500 to $600 a month, all of a sudden, that $200 a month as rents drop, it's now -3, which is why we almost went bankrupt in 2008, 9, 10. And like that itself is a workshop.
Yeah.
Like our experience in those first 5 years of what we were doing and how we were being taught to do it is a full-on workshop to say, do not do this.
Yeah.
Period. And, I'm a pretty opinionated guy, and a lot of people come back and say, well, it's just your way. Well, that right there is that's seriously pure education for free that we could give.
Oh, yeah.
So easy. Real estate is easy if it's played properly.
Yeah.
Right?
Yeah. It's
a game. It's a game.
But that's a tough one, though. So how do you make it easy when you don't know different?
Well, right. So that goes into, right now, our next topic is going to be top cities to invest in. My favorite 3 cities to be buying in right now. But before we get into that, to answer your question, you have to follow the people that don't just say it, but are actually doing it.
And I'm just thinking about the bad choices we've made. I'm rifling through lots of them. What took us down those paths?
Oh, ego.
Yeah. I'm going to stop right there.
Yeah. Yeah. Ego.
If it had come back to fundamentals.
Totally.
And absolutely.
Yeah. No, that's a good point. Yeah,
I knew that answer.
Thanks. I'm just glad I got it right in the first shot. So, but in saying all that, the segue into before we get into the top towns, or my top 3, there's a report put out by the Real Estate Investment Network, which I'm going to kind of dive into a little bit. And then there's another report put out by Prairie, which is another good article. Rain's article is really, really good as well. But before we get into that, it's super important that you follow the people that are not just talking about doing it, but are actually playing the game on a daily basis. And there's lots of groups out there that are being run by people who actually don't own any real estate. And it's very important that you just understand that.
It doesn't matter who it is. Do your own.
That's the point.
Legwork.
That's the point I'm trying to get to. Sorry, I lost my thought. But do your own homework on the people that you're following.
Yeah.
Because it's gonna pay off, or it's gonna hurt you in the end. So here's my top towns. Edmonton. Now, I love Edmonton, and how you determine what a top town is, you want to look for things like population growth. You want to look for things like GDP growth. You want to look for activity in the job market, education sector, roadways, transportation, LRT, stuff like that. So if you look at Edmonton, there's so much activity happening in Edmonton. Our GDP in Alberta is supposed to be the highest in the country. I just read an article that there's 76,000 new jobs created in the country, and 26,000 of those were creating in Alberta. So Edmonton right now is a massive opportunity. There's also Vancouver and Toronto, where a lot of people talk about Vancouver and Toronto, but the prices, if you actually look, there's a curve, right, in real estate that follows the trends. And so we have GDP growth, we have rental demand, we have housing costs go up, so on, right? So Vancouver and Toronto are at the top. And I've come to realize in this game, or any game in business, stocks or real estate, what goes up comes down. And so if you're starting to buy in this area, make sure that the fundamentals are there. Make sure you're buying for cash flow first and foremost. Because if you're buying for purely for appreciation, and you're buying it in here and the market drops, now you're screwed.
Do we know anything about this?
Oh yeah, we do. Yeah, we probably bought 50 in that.
This is where our ego came in.
Totally.
Yeah.
And we share this information with you because we're not making this up. It's not like we just rolled out of bed today and said, "Hey, let's talk about this."
Well,
we actually lived this shit.
We did so good here,
totally.
And leveraged, and then just we thought we knew more, and
we thought we knew everything.
Yeah.
Back then, and we thought, it's funny. In 2008, I remember I was in the gym as a personal trainer, and this guy, my client Kelly, is running on the treadmill. And Kelly was investing in real estate for many, many years before me. And Kelly turns to me, he's like, "Jared, you should sell all your properties because what goes up comes down and the market's going to crash." In 2008, in July 2008, he told me this. I'm like, "No, Kelly, there's no way it's going down. There's not a chance." What happened mid-2008, in August, mid-August 2008? Well, the market started to drop. By 2014, we were in a global recession.
Yeah.
And, by August 2008, we were in a global recession. By the end of 2010, we were almost bankrupt.
Yeah.
So be careful with this because pigs get fat, hogs get slaughtered. A normal buying cycle of a person, and I've shared this before, but, people come in, this is the normal buying cycle. They get greedy here. They're fearful here, so they buy, they sell at the bottom, and then they buy again. And then they just keep on repeating it. So they buy high, sell low, buy high, sell low, buy high, and they just keep on repeating it. Typical buying cycle. So what we want you to do is just redefine it, recreate it. So Edmonton, in my mind, is by far the best city to be investing in. Not Vancouver, not Calgary, not Chilliwack, not Abbotsford, not no other place but Edmonton. There's just a lot of great fundamentals. I don't feel Calgary makes this list for me. I think there's a lot of upside in Calgary. I just think it's going to take a little bit of time to get into that. My second one, there's going to be a lot of people that might disagree with this. And maybe even Krista might disagree with this. I can't even wait. I don't even know. Krista might even disagree with this. But my second top town to be investing in is Grand Prairie, Alberta.
Hey, we've got some properties.
Well, yeah, no, so if anyone wants to buy any, call us, 780-443-1161. No, I'm totally kidding.
Big joke, but no, we have
I'm totally kidding. We have great properties. Grand Prairie, Alberta is on the uptick. Rents are going up faster than we've seen, probably since 2010.
Yeah.
And the vacancy rate, I went around and called 10 management companies last month, and all of them are at 0% vacancy. There is a new Gen X project outside of Grand Prairie. There's all kinds of play in Grand Prairie. The Grand Prairie area is vibrating.
Well, truthfully, it's almost my hometown, close. But this is a soft spot in my heart.
Totally.
We would not be where we are in real estate without this city.
Well, we almost went bankrupt because of this city.
It's a love-hate thing because it got us to where we got to, but then it almost...
Grand Prairie is a total love-hate.
Yeah.
So here's the thing with Grand Prairie, Alberta. If you play the game properly in Grand Prairie, there is a massive opportunity to make a shit ton of money.
Right. Yeah.
But you got to understand with Grand Prairie, it has peaks, and the peaks are high.
Yeah.
But the valleys are also challenging. Mm-hmm. So here's the key. In the peaks, if you're peaking and you're making tons of cash, what do you do with it?
Bank it.
Bank it. Buy down debt, bank it. Have access to it.
Yeah.
And if you think you have enough, you need more.
Right.
Like us, we had $500,000 come in 2008, and we thought that would be able to ride out 100 properties. First of all, that was a stupid number. We should have had twice or three times as much as that. We didn't have enough because we didn't understand the game. Being in Grand Prairie for the last 13, 15 years, this is an excellent opportunity to be buying.
Yeah.
Unbelievable. Mm-hmm. And the rents right now are starting to move, but house prices have not started. So rents are moving like this, and house prices are just coming up behind it now, which means there's a gap where that's pure profit.
Right.
Because if you can come into the game and pick up a house here as it's climbing, but rents continue to rise, you're going to make, we're going to see $1,000, $1,500, $2,000 a month of cash flow again in Grand Prairie.
Wow.
I guarantee it. I will. Tough word to say is guarantee.
Yeah.
Okay, so
shouldn't say that.
I am betting, and if I was a betting man, which I'm not, but if I was, I would be putting my money on these two cities.
And what's the population here now?
Oh, it's probably 65,000.
So wouldn't it be logical to think it's a lot less boom and bust than it used to be?
Yeah, well, so the market's changed a lot. So in 2008 it tanked. In 2014, 15, 16 it tanked because we just went through another recession when oil dropped. So what's happening is these companies are starting to get more robust. They're starting to understand and take less risk and be smarter, trim costs. Remember, every time there's a recession, what happens? Companies trim costs. Yeah. They trim the fat. They get more effective and efficient in running their business, right, which means their profits go up, which means as oil and gas go up. So understand oil. Oil is now at $65, $66, but our West Coast Select is not. Okay, so just because oil is at 66, I think we're trading today at $38. But once again, as oil goes to 75, this is going to creep up to 50, so on and so on, right? So Grand Prairie is a good opportunity. Very important that you have a good team in Grand Prairie, whether that's a property manager, obviously, if you don't live there, a good agent, obviously, a good inspector, obviously, and really go visit it. It's I don't want to say it's a cool town. It's a rig town. It's an oil and gas town. Yeah. But there's lots of opportunity. Yeah. Before I go into the third top town, I'm going to tell you the towns to stay away from. Right now, I don't want to say stay away from.
In your opinion.
This is all my opinion. Right. I have no.
According to the fundamentals.
This is just what I'm seeing in buying, in managing, in clients, in what's going on in the economy. Trends of Alberta. Here's the thing. Right now, the market's going up, and as the market is going up, vacancies are going down. So 8 months ago, we were at about 7-8% vacancy. Now we're sitting at our portfolio in Edmonton, sitting at about 3% vacancy. So with that said, as the market goes up, anyone can buy and look like a rock star. Mm-hmm. Anyone can, because we're going to see that. Yeah. We're going to see this trend of people buying right now and looking like a genius for the next 5 years. And some agent who's selling you a piece of shit in the wrong part of in the city or in a different community altogether, you're not going to know any different until 5 years from now. Right. How many times have we seen this? All the time. Again. In 2014, 15, 16, we saw it dozens of times. Yeah. Probably hundreds of times.
It was hard to not get caught up. Well, and people be like, oh my God, you got to look at this area. And it was hard not to get caught up.
Well, and you know me, I get pissed off. Yeah. I don't get caught up. I get pissed off that someone bought this piece of shit from somebody, and I get mad at that person for selling this piece of shit. I don't mean to swear, but I get a charge off it. Yeah. Because there's people out there that if they don't sell a house, they don't get a paycheck, period. Yeah. So right now, if it were me, I would be staying away. I'm going to put away in case someone's just tuning in. Stay away. I would be staying away from Spruce Grove, Spruce, Stony, Beaumont. I would be Fort. I'd be staying away from all those towns. Now, I'm sure there's people out there that are going to say, well, no, Spruce Grove is this, and Stony Plain is that, and Beaumont's this, and Fort Saskatchewan's that. I'm sure that everyone's going to have an opinion. Yeah. I also believe that you can buy a property in any town and make it work. Yes. Okay, so you can buy a property in Spruce Grove or Stony Plain or Beaumont and Fort Saskatchewan and make it work. If you're buying in these areas, make sure you can self-manage. Right. Because if you're buying from out of town, say Vancouver, into one of these four communities, and 5 years from now we see oil back to $28, you're screwed. Yeah. Because rents are going to plummet, and you have a one-bedroom basement suite or a micro suite. Right now, there's a company selling houses, new builds, with a micro suite in the back that is 400-ish square feet, and both bedrooms are under 80 square feet. One of them is like 65 square feet. Those will not rent out in the down market. Right. And people make the mistakes in buying in these communities because right now they're starting to buzz, but in the downturn, they just don't. Right. Period. So the other area that I really am starting to like is Leduc. To be honest, I've never liked Leduc. I've never liked Leduc, and that's because I probably
think
grew
this
up
is
in
hockey. I
yeah.
think this is Northside Edmonton coming.
So I was a Northside Edmonton guy, and I played for the Maple Leaf Athletic Club, and we just hated playing Leduc. So, but if you actually look at Leduc now, like Leduc's actually growing. Like the city's closer to Edmonton. There's the marijuana plant, which is massive. That's going on out there too.
That place is.
Nisku Business Park is expanding like crazy. As the oil and gas starts picking up, people are going to want to start living there. It's a quick, easy hub access to the airport, so that plays a great factor.
Mm-hmm.
So I like these. These would be the order I'd be buying in. I would buy in the Leduc last after these two. I wouldn't pop into Leduc first because once again, as the market drops, Leduc's going to take a hit.
Right.
As the market drops, Grand Prairie is going to take a hit. But the rents will get so high in Grand Prairie that there's so much money to be made that if you play the game properly in the downturn, you'll be able to ride it out.
Right.
Edmonton's a safe play. Edmonton's just going to be a steady increase over the next 20, 25 years. Rents will go up. They'll drop 10 to 15%.
Going back to your location fundamentals.
Correct.
Yeah.
Well, yeah, so then from here, you have to get into where to buy in Edmonton because once again, there's lots of bad areas,
which we talked
about last week. So Starbucks, Walmart's.
I'm excited to see. Let's go.
No, top three. That's all I got.
Oh.
Yeah, no other. Calgary's going to be a good play. I think Calgary's going to be a good play once we start seeing some steady supply of the oil and gas sector. It's too bad about, was it Amazon that was looking to come to, it was Amazon that was looking to come to Calgary and they've narrowed it down to Toronto maybe. But it's too bad that didn't happen. But the commercial sector, the industrial sector in Calgary it's going to take a little while to fill it up because it's not that easy to move a company.
Right.
So these companies have moved out of Calgary. So to come back into that downtown sector, it's going to take now. There's lots of proper areas to buy than just downtown.
Oh yeah.
But to get those head offices back, it's not as easy as one thinks. Like with moving a house, you just throw your stuff in a U-Haul and away you go, and you just call and change your addresses, change utilities. Moving a company is a little bit tougher.
Yeah.
So that's all we got. Anything you want to
add? No, I don't think so.
Nothing.
I'd love to hear.
You talked so much this
I know. Thanks for really backing down.
Yeah.
We'd love to hear your questions. We'd like to hear what you're dealing with. We'd love to answer what's relevant to your investment cycle career right now.
Next week we're going to start breaking out properties. Just with the market starting to trend up, it's super important that we are buying the right properties that are going to cash flow the right amounts for the long duration versus just buying it for the interim. And so next week we're going to start talking about a 10, 15 year plan on how to buy a property for success for the next 10 to 15 years. And here's a kind of a common. I'm going to leave you guys with something to think about as we walk away. If you're investing for 20 years, how long do you have to keep property in that 20 years to have success?
Ooh, it's like a riddle.
Think about that.
I'm going to think about
Most people will come back and say, I have to keep it for 20 years.
Right.
Most people will do that. Most people's plan is to buy the property and hold it for 20 years. Next week, we're going to talk about why that might not work. Yeah. It could work, right, but a different approach and a different thought process around it. So with that said, I'm Jared Hope. This is Krista Hope, husband and wife, Tuesday Tilt Talks. We are the owners and founders of Tilt Property Group. And share it, like it, comment next week. Ask any questions, and we'll do whatever we can to answer them for you guys.
Have a great week.
That's it?
Yeah.
See you guys.
See ya.